To Phillip Streible, Senior Analyst, Blue Line Futures. Good morning, Phil, and thank you so much for joining us.
Yeah, thanks for having me.
Well, Phil, I'd like to kick off with the dynamics behind the gold rally because specifically yesterday, it was accompanied by an equities rally, certainly very modest equities rally, but still a rally.
Yeah, I mean, if you look at gold, the volatility had considerably spiked over the last few sessions, hence that large move that we saw overnight in gold and silver. The correlation between gold and the dollar index. Remember, for a while they were moving in tandem, and then they broke away. The correlation is almost 100% negative. So a small rebound in the dollar index in the overnight market, just a very tiny one, we saw a massive effect on the gold market. So really the collapse in the dollar to the 2-year low, also record low real interest rates. And then the Federal Reserve has been considerably dovish, and they look to continue their quantitative easing measures, going forward to help try and support the market in relation to the pandemic continuing to spread.
And what are the levels that you imagine in the medium to long term? Can we imagine also 2K per ounce?
So, yeah, we saw 2000. That's the high of the December contract. It was like 1974.70 on the front month contract, your August contract. But, the key level of support, I think, is 1900, but it's just a number that's posted out there. It's not, you have to look at the volatility, and volatility has spiked significantly in gold. The average range for gold for a while, it was making these $30 days pretty standard procedure until yesterday it spiked up to about $74. So the movement is becoming quite wild in the market, and it's going to trigger a lot of sell stops in there, clean people out. People are going to become emotional about it because the volatility is so high. They're going to jump back in, and it's going to turn into a roller coaster for the next few sessions.
So what are you suggesting?
Well, I think you still need to be long on gold. On like a correction to that, like today looks like a pretty decent buying opportunity on there. But when we get closer to those contract highs again, I think you got to take part of your position off. So if you have a full contract on, which is 100 ounces, you might want to sell 10-ounce contracts against it when we get to the high end. But don't go naked gold to the short side at all, because I think that it's just too volatile at the moment for most people.
Well, when we talk about a silver, are you still bullish on the commodity?
Yeah, I like silver a lot. I mean, silver doesn't have the same fundamental dynamics that it had when it reached $50 an ounce. That's when there was a shortage, and solar panel demand was skyrocketing at that point. They used a lot of silver at that point in time. So it's tracking gold higher as a hard asset, as all the metals are, copper, platinum, palladium. They're all rising with inflation expectations. Inflation has gone up significantly in food costs and also in medical costs. I think silver, it's a bit more emotional. You get a bit more leverage than you do on gold. For the same dollar amount in gold, you can get 5,000 ounces of silver, and that ratio is 80-1. So the volatility is going to be much more significant. I like silver, but probably closer to $20 to $22 range, not $24 to $26.
Well, you just mentioned the copper. So I was wondering if we just look at the levels of the copper right now, it's up by 0.44%, almost 0.5% lower. What is it suggesting when we talk about economic outlook?
Yeah, it's tracking some of the U.S. equities. I mean, copper is a little bit more economically sensitive than like gold and silver is, where silver normally has an 80% industrial demand aspect, and the investment demand is only 20%, where copper is mainly all economic demand. So we're seeing a lot of the stocks, U.S. equities out there, their earnings expectations are coming down. The economy looks to be taking a step back, like they're tightening up. I live in Chicago. They're tightening up the number of different states that we could travel to. They're imposing new quarantines. We're not seeing that demand and take off in crude oil. So I think naturally copper prices are going to start to soften up just a bit.
Well, let's just have a very quick look also, at the crude oil, because it's been stuck over there at the current levels for a little while. So what's next for the USO specifically?
So I think crude oil prices are going to decline. I really believe that we've been stuck in this $40 to $42 range. We haven't been able to draft to the upside as far as a rally, anything beyond that. I think that if you look at the supplies, are continuing to increase. The demand is kind of leveled off. It doesn't look like the driving season is having this like miraculous comeback because, like I said, they're tightening down restrictions on what states we can travel to by not having, we have a 14-day self-quarantine after that. So if you're not going to drive for 2 weeks after you travel somewhere, that's going to take down a lot of that driving demand. So I think $35 crude oil is most likely in the cards in the near term.
Well, let's have a very quick look at a USO. Certainly, this week we're going to see a lot of energy majors quarter results. So, what are your expectations? It's been quite a quarter in terms of crude oil price decline.
So those earnings expectation quarter over quarter, they're going to have a snapback because we're coming from the bottom, from zero. So any bounce up is going to look dramatic. But I think after this, we're going to start to level off here. The outlooks are going to be softer. So I think that all these energy companies are going to start to slide just a bit. All the major companies out there are having, you look at guys like leaders like Microsoft and McDonald's and things like that. All of them are having softer outlooks going forward. And I think that's going to transition into all the different sectors of the markets. But some of them are going to be harder hit, especially the ones that are consumer discretionary dependent.
All right. Thank you very much. Phillip Streible, Senior Analyst, Blue Line Futures. Thank you so much for joining us. And of course, have a great week ahead.
Yeah, you too. Take care. Thanks for having me.